Welcome to Wealthy Her, a podcast aimed at empowering women on their journey to wealth. We created this podcast to ignite inspiration, empowerment, and promote a sense of community among women seeking financial and professional fulfillment. I'm your host, Shauna Fannin, and I'm honoured to have you join me today for our latest episode, Investments and the New World. In our previous episodes, we have covered quite a few different aspects, and I thought I would just summarise them today. So the first one is why invest at all, for that matter, and why do we need to have a seat at the financial decision-making table, most specifically as women? Why do we tend to look towards community in our financial decisions? We've chatted to Amber Fillery about her then upcoming attempt at the Guinness World Record for the longest swim underwater, and I'm delighted to say that I chatted to her this morning. She did the attempt yesterday, and she completely nailed it. So we're incredibly proud and thrilled for you, Amber. And we'll be talking to her a little bit later, not today, but in a future podcast. In episode 3, we chatted to Leslie Swart from Carrick Consult about securing your wealth before widowhood. And this really was looking at the very important elements that need to be put in place in making sure that we minimize the probate period. So just making sure that the estate was wrapped up really quickly. So today, however, I thought we should start chatting about investments and what the world of investing is about and all the things we need to take into account. And today I'm going to be covering things like what types of investments there are, what is a passive versus an active investment, and what we're likely to see in the development of AI, so artificial intelligence. And then, of course, things to be aware of when you start investing. So I think just to get started, really, it's really important to understand what you're trying to achieve from an investment, because there are so many out there. And if you don't have a very good idea of what it is you're setting out to do, then you might find yourself on the wrong course. So it's an important aspect to consider when you're looking at investments. What am I trying to do? And this all comes down to the return that you're hoping to get. So what is a return? Well, a return is the amount of money that your investment can make. It can be seen as a profit or a gain, or some money that you're actually getting as income. And depending on which investment you choose will determine what kind of return you're going to get, whether it's going to be income or it's going to be a gain. So those things will differ, but they are all essentially the same thing. And this tends to be expressed as a percentage. So, for example, if you put your money into a bank account, into a savings account, then it will probably on average earn you a 5% return. And that's considered to be really quite basic, quite conservative. The idea is that that's money on demand, so it needs to be there. When you go to the bank, you need to be able to withdraw it. So because they're giving you the benefit of that money being there, you're going to get a very small return. And 5%, I think, is a really good place to start. It's an easy number to remember. It's an easy example to remember. Most of us have bank savings accounts, so it's an easy go-to in terms of where do you start with investments. And that suggests that anything higher than 5%, and I'm talking here in South Africa, anything higher than 5% would be a really good return or would be progressively better, and anything lower might not be as good because a bank savings account is really accessible. So why don't we just leave everything in a bank account? I mean, if it's giving us 5%, it's easy to access, it's easy to think of. Surely just having your money in a bank account is going to be enough. Well, no, because there are different things that detract or rather erode your wealth or erode your investment that you need to take into account. And those are things like inflation. In South Africa, inflation, the government would like to aim to have it at around 6%. And it's always interesting to hear what clients say inflation is. Some people say 6%, some people say lower, some people say much, much higher. And just what is inflation? Well, inflation is the cost or how much things will increase in cost as the year passes. So that could be affected by things like load shedding. Load shedding is, of course, we all know it, where they cut electricity and we can't work. And so the cost of producing something for an hour becomes that much more expensive. So inflation being aimed at 6%, it could most certainly be higher, and one needs to take that into account. Back to our bank account. Why is that important? Because if my bank account is only earning me 5% and I've got inflation of 6%, then quite logically, my investment, the original amount that I saved up for, that I put into the bank account, that's actually slowly eroding, and it's not good enough. So that's why you can't just leave your money in a bank account, because it's going to erode. what other things do we need to take into account? Well, the fact of the matter is that we live here in South Africa and everything we own is imported. If you look around where you are in your house right now, if you consider all the things that we have around us, they're largely imported. So rand depreciation is really, really important. We have to be able to keep up with our buying power offshore. The rand generally, over an historic period of 10 years, erodes by about 5% a year. But last year, it lost 24%. So that's really, really important when taking into account where am I going to invest and what am I going to invest in. And it starts to look at why are you going to invest onshore and why are you going to invest offshore. If your buying power is not keeping up with the amount the rand is valued at, and you're buying offshore, logically you're going to start eating into your investments as well. So why can't I leave my money in a South African bank account? Because inflation is going to erode it away. And what about if I move my money into an offshore bank account? Would that be good enough? Well, certainly you would get around the rand depreciation there, but you would still not be keeping up in line with inflation. So it's not just one cost or the other. You need to take both into account. And the third thing that's going to constantly affect your income or your investment is how much you are taxed on that return. Just a reminder here that a return is the amount of income or gains that you're getting off your investment. So there will be a tax associated with that. If it's a gain, it would be capital gains tax. If it's an income, like if you had an investment property, then it would be income tax. So you need to take those three things into account every time you're looking at an actual return. So we're looking at returns. And I said to you that a return is quite often expressed as a percentage. And why is that important? I have so many clients come back to me and they say, I've got this amazing investment. It made me 4,000 Rand. And that's actually irrelevant. How much money it made you, that's essentially what you're wanting at the end of the day. But in terms of assessing whether that's a good investment or not, you really want to assess it from a percentage perspective. Why? Because if I've made 4,000 Rand off a 100,000 Rand investment and you've made 3,000 Rand off a 30,000 Rand investment, your investment is better. Your investments earned you 10% and my investments only earned me 4%. And I actually did the calculations before the podcast, so don't worry in case you didn't figure that, work the sums out. But essentially, that's why you want to know what that percentage return is. You want to know what percentage fees are, and you want to know what your percentage return is rather than the actual rand value, because that rand value can be really misleading. Or that dollar value, or that sterling value. It doesn't matter about the actual rand in this case. We're looking at what is that percentage return. There's no way to assess an investment without looking at the return. I mean, I spoke to you about a bank account and I said 5%. So if I'm going to look at any kind of share option or any other kind of investment, I need to look at that percentage return. And that's the question you're wanting to be asking when considering an investment. If we look at percentage returns, it also brings to mind why property as an investment can be a very good investment, but can also be a little bit misleading. As South Africans, we really like property. We tend to invest in a lot of property. We like to look at our investment and know it's there and touch the bricks and make sure that we can actually see our investment. And there's many reasons as to why that might have come about. But getting down to property as opposed to a liquid investment. And a liquid investment is really a cash investment. So it's putting money in a bank account or putting it in a portfolio. But the idea that I want you to think of here, excuse me, is the fact that you can easily sell liquid investments. You can easily sell shares. You can easily sell whatever that investment is. You can move money out of a bank account. It's really easy to withdraw it and invest it in something else. Whereas a property can take a number of months, as you know. I know I spoke about it in a previous podcast, but again, if I think of clients who've trying to sell their houses in Johannesburg at the moment, they're having a really hard time. The property market there is not what it used to be, and they're battling to sell those properties. So that's considered to be a relatively illiquid investment. Property is also very good because it makes you think of sector-specific investments. So what do I mean by that? Well, if I think about a geographically confined space, like you've got a house here in Cape Town. It's not a house that's in Cape Town and in the UK and in New York, as an investment might be. It's just a house here in Cape Town, which means anything that happens in Cape Town is going to positively or negatively affect your house. So it's quite geographically specific. It's also a property. It's not a property and a fixed income investment and a share. It's just a property. So now we are very confined in terms of what happens to property in Cape Town. So it's a very, very specific investment. And when you're looking at investments, you potentially want to have a broader play on the field. So you want to have more diversification. So what do I mean by that? Well, if you think about investments and global companies, I mean, the companies that you invest in nowadays, or the companies that you can invest in nowadays, are known as giant cap companies. There's a number of different types of companies. But if we look at giant cap companies, what are they? Well, they're companies that span the whole world. Think of Microsoft or Visa or PayPal or Apple, for example. Why is that important? Because if something specific happens in one geographical location, it's certainly going to affect them. But their enterprise spans the entire world. They can easily shift. I say easily for means of explanation, but they can actually shift their focus to another geographical location. So let's say something happens in China, they can maybe focus more on the US, for example. And that's really important because if I think about, again, a property here in Cape Town, you can't shift that focus. It's here in Cape Town and that's all there is to it. So having diversification means really making sure that your investments, you're taking advantage of the world that we live in and making sure that your investment is getting the best possible return. And if I put that into perspective of, let's say, World War I or World War II, people are quite concerned about the effects and trauma that's happening in the world for obvious reasons. But just looking at it from an investment perspective, when we were living in World War II, as South Africans, we might have some kind of trading offshore. We might have had quite a lot, but we certainly didn't have global companies like Microsoft and Visa at that time. So we've got far more access to far greater returns now once your money is offshore. And it's really important to try and understand how those investment choices can influence you. Another thing about property, South Africans really love property, as I said before, but another thing about property is that property has two different kinds of income or two different types of growth, right? When you're looking at property, I tend to not, as an investment, I tend to not include my home. Because my home, if we go back to what we were trying to do with investments were there to earn us a return. We wanted to actually have some kind of income being generated off it. And mostly people might have a room that they rent out or they might have a little cottage, but mostly people don't have that. It's just their home. And so it is an investment, but it's only going to potentially earn them wealth when they sell the house down the line or the flat or whatever it is down the line. But as an investment in terms of generating income on a more regular basis, people tend to invest in properties and think, okay, this is going to be a great investment. We're going to make X amount of money. It's going to be wonderful. And what tends to happen is unless you really run that like a business, you'll probably find that the returns you're making on that property are far less than you imagined. And that's after you've paid rates and taxes. There's an increase in the water levy. The tenant didn't pay the 1 month. The geyser broke. You had to put in solar, etc., etc., etc. And once you've actually taken all of those costs into account and you work out how much income you made for the year, we quite often find that our clients are only getting a 2 to 3% return on their investment. So let's just go back to that bank account where I said we started. If we go back to that bank savings account and that's earning you about 5%, slightly higher at the moment, but if it's earning you about 5% and your property is actually only earning you 2 to 3%, and you're doing it for an investment or from an investment perspective, and it really speaks to itself, the property might not be the best option. Again, there's two sides to a property. So you've got the income coming in. I'm just going to pause there for a second. The income's coming in. You've got all these expenses, but also remember that when you're earning income off rental, it's seen as income and it's going to form part of your income tax, which is a far higher tax than, say, capital gains tax, which is what you would earn if you had a liquid investment, depending on the type of investment. So your rental income's coming in. You're not earning as much as you thought you were going to be earning. You eventually sell the house and you earn capital gains tax. So property can grow in value. But when we're looking at growth in value on property, we also need to take into account what was inflation over that period, Remember what I said to you is every investment you need to assess three things: rand depreciation, inflation, and taxes. So what was the inflation over that period? Is your return actually in line with inflation, or is it beating it? And I'm talking about selling the house now, so it's grown in value and you've decided to sell it. Has it beaten inflation? What is the rand depreciation? How much has the rand depreciated from the day that you bought it to the day that you sold? Would it not have perhaps been better to buy a property offshore? When buying a property offshore, there's many, many different options that you can consider. But what are the things we have to remember? Inflation and taxation. So those three things crop up all the time. And when we're looking at investment choices, that's what we want to do. We want to say, what is the best possible investment that I can make here in order to generate the kind of returns that I'm wanting? And those returns are going to be after inflation, taxation, and rand depreciation. So we've talked about returns, we've talked about various investments, liquid versus illiquid investments, and now we're going to have a look at passive versus active investments. So these are questions that pop up quite often when I'm talking to clients. I held a seminar over the weekend, and these were questions that popped up. I'm so impressed actually because more and more, the more people I speak to, the more they're getting invested and the more they're learning about investments and these questions like, what is a passive investment and what is an active investment? So I like to think of things quite simply. I don't like to overcomplicate things. And I know that there'll be some very sophisticated investors out there and there'll be less sophisticated investors. So please do bear with me if I'm not talking very high level here, because that's the way I understand things. So what is a passive versus an active investment? Well, a passive investment would be something like an ETF, an electronic traded fund, for example. And how does that actually work? So the way I like to think of it is if I had to track the price of gold, gold could go up and gold could go down. And if I just tracked it and I didn't do anything else, if gold went up, my investment went up. If gold went down, then it would go down. That would be considered a passive investment because I'm not actively going, oh, gold's gone up, I should buy more. Or, oh, gold's gone down, I should definitely buy more of it now. Let's just do that. You're not doing that. You're actually just following the route of it. And those types of investments, those indexes or indices, they're kind of like a benchmark that you can use. And those benchmarks can come in a variety of different forms. You can have a gold benchmark, you could have an oil benchmark, but you could also have a collection of things. Like you could have a collection of cryptocurrencies, for example, and you could have an ETF that did that. And you could say, well, okay, we're always going to have 10% exposure to these different cryptocurrencies, and that's what our index is going to be, and that's how we're going to track it. So those could be a passive investment, for example. So it doesn't necessarily have to be like gold or oil or one particular thing. It can be a number of different things. You could also track something like the S&P 500 or the FTSE 100, which is really an index just looking at the top 100 companies in the UK. Right? So if it goes up, you go up. If it goes down, you go down. Very, very simple. Those are called passive. And why are they important? Because they tend to be much cheaper than active investments because people are making those decisions. There is always a fee attached to them, but they tend to be cheaper. Does that mean they're better? No. Let's have a look at active investments. Active investments are investments where there's a constant decision-making process going on. So let's say, for example, we've had the property crisis in China, and you've got overexposure in emerging markets. Just a sideline here, what's an emerging market? Emerging market tends to be part of the BRICS group, so that would be Brazil, Russia, India, China, and South Africa. They're not developed markets like the US or the UK. So if you had an overexposure in China and the property market crashed, as we all know it did, then possibly your investment's going to be at risk. So you might say, okay, we're going to actively sell out of that. So actively managed investments versus passively managed investments are not necessarily better or worse. Quite often I come across clients who go, yes, but Berkshire Hathaway suggests that if you just hold passive investments, you'll do extraordinarily well. And that may be the case, but the world is is very much a changing place. And I'm going to allude to it in a moment with regards to artificial intelligence. And there's definitely a place for active and passive investments. And I think it really comes down to understanding what it is you want to do with your investment. So when you're looking at what do you want to do with your investment, what am I talking about there? Well, if you've got 20 years to get to retirement, then you've got quite a lot of time to actually be in the market. You've got quite a lot of time to handle potential drops in the market. You've got quite a lot of time to recover from things that might have not worked out as well as you wanted them to. But if you've only got 3 years to go, or you're actually actively using those funds, then you might want to think about your investment slightly differently. So understanding where you are, understanding how much time you've got is really important as well in terms of determining what kind of investments you're going to invest in. And this really leads me on to, well, where does one start when wanting to get invested? There is an old adage that says time in the market solves everything. And there's quite a few important parts to that. How long is that time period? I think if you think of anything that happens in your life that's quite jarring, when that occurs, it's obviously quite traumatic. It can be quite difficult. But after maybe a year, or certainly after 3 years, that jarring effect tends to dissipate somewhat. Certainly after 3 to 5 years, that certainly becomes less of a thing. It might still have impacted your life, whatever that might have been. And from about 7 years onwards, it's something that becomes a memory and that might have changed the course of your life, but it certainly doesn't have that jarring element to it. And the reason I've brought it up in that way is if you think about a crash in the market or a market correction, at the time it can be quite scary, extremely scary. But a year later, 3 years later, 5 years later, 7 years later, that path tends to smooth out and the market tends to correct and the market tends to find new opportunities. So does that always happen? Yes, it does tend to happen, because if you think about a company and there's a market correction or there's something dreadful that's happened in the company and their share offering goes down, after a year, they will have found a way to fix it. After 3 years, they certainly will have put in processes to try and prevent that from happening again. After 7 years, certainly they're going to be on a different route and it's going to be something that they remember, but it's not going to have as big an effect. Of course, companies also fold, but one's just talking about the general course of things and the general course of the way one makes decisions in life. So how much time you have in the market is really important, and it tends to fix quite a lot in the market. So really importantly, when the market dips, don't necessarily sell unless you need those funds. But if you're not needing those funds, do not panic. Sit through it, listen to your advisors and make sure that you just hold the course, because if you stick to your long-term goals, it will more than likely come right. So time in the market solves things, and it really talks to the different types of risk profiles that we have. So what is a risk profile? A risk profile really talks to what kind of investment you're going to invest in. You might invest in a conservative investment or an income investment. It might be balanced. Conservative and income investment tends to be for people who are needing to access those funds within 1 to 3 years. A balanced investment would be from about 3 to 5 years. You're going to access it in that period. And a growth investment would be 5 to 7 years or plus. So if you're 20 years old, for example, and you're investing and somebody suggested to you, or you just feel quite nervous about it, you might find that, and I find that quite a lot, that you'll have put all of your funds into a conservative investment. And that's actually not the right place to have it, because you've got 40 years to go before you actually retire, and those funds need to work. You're still building your wealth. And quite often I think that people get confused between how they're feeling, which is nervous, because they don't really understand what the investment is about, versus how they should actually be investing. So you're not going to know everything about investments, but have some kind of idea of where you should be placed and why. If you've got 20 years to go or 40 years to go to retirement, certainly you should be in a growth-orientated investment. And as you get closer to retirement, so you pull back on that, you start going towards a more conservative basis. Be that as it may, every portfolio needs to have a conservative, a balanced, and a growth element. I don't want to get into it too much, but have an idea of those three aspects. It's really, really important. So every portfolio will have an income, it will have a balanced element, and it'll have a growth element. And that growth element, let's say you're a client who's balanced, who doesn't want to have too much risk, but you definitely want your portfolio to grow. Generally, what we would do there is we'd say, okay, well, let's just allocate about 20% to a growth element. And that'll very much depend on you, the individual. So I'm talking very generally here. That might not apply to your portfolio. You'll discuss that with your financial advisor or your wealth planner and take it further from there. But the reason I'm bringing it up is I want to talk to crypto. Now, crypto is extremely controversial. Nobody will get it right. But I think what one wants to understand here is when you're investing in a growth share, let's say, for example, you decide, okay, well, I'm just going to stock pick. I'm going to pick Apple and I'm going to pick Visa and I'm going to pick whatever it is. How do you know that you're getting it right? Like, why would you even go to a financial advisor if you can just talk about those shares? The reason you would do that is because in order to really know whether you've picked a good share or a good stock, you need to research that company. You need to know what their balance sheet is doing. You need to know who's running the company, much like a family. You need to know who's making the decisions in the family. You need to know, is there cash in the bank to get them from day to day? Is there a plan to get them from year to year? Like, is there a plan to get your kids through school? Is there a plan to, for retirement? There's a lot of things that have to be taken into account, and the same applies to a company. And if that plan isn't there, then the company might fold. So when you're choosing a share, if you don't know that plan, then how can you be certain that actually it's going to be a good investment? And when we talk to crypto, it's very, very similar. So crypto is controversial because it's very much in the news and the media, and everybody has some crypto. And I wanted to bring it up because the question was asked of me this past weekend. What about crypto? So you can make a huge amount of money on crypto, and you can also lose a lot of money when it comes to crypto. And I think you need to understand when you're investing in crypto what it is that you're doing. And we've spoken quite a lot about investments and what it is we're trying to achieve here. So the argument is quite often, well, there may be a new type of currency that comes to the market where people just pay with crypto, and that may very well happen. I don't think it's going to happen in the next 3 to 5 years. It might happen after that, but I don't think so. I don't know to be certain. But I want to get back to what it is that you're trying to achieve. So you might be hedging against the rand depreciation. We talked about the rand losing 24% value. Fine. You can also do that with dollars and euros and sterling, for example. So you're doing the same thing there. And what's important about that is that all you're getting around there is the rand depreciation, if that is your motive. So you might also say, okay, but crypto's growing in terms of value. So then you're kind of looking at it more as a share. And if you're looking at it as a share or stock, you need to really understand what's going on with it. Just like you had to with a company whose share you were buying. Just like a moment ago I said, it's like knowing what's going on in a family and what the plan is. So if you don't know what the plan is and you don't really understand how crypto works, then you are taking a chance and you're hoping you're getting lucky. And that's fine too. You can do that. It's your money, right? You can do whatever you want to. But understand that there is potential risk, that you might be being influenced by a community of others who do understand how it works. So understanding that process is really important. I don't know enough about crypto to really give a convincing argument about it, so I'm not going to. But I want you to understand that when you are picking investments, know what you're trying to achieve. And you're trying to achieve some kind of income. You're trying to achieve some kind of growth. And when we create portfolios, things that are volatile, that can go up and down, like crypto, we would probably only allocate 20% if we knew what was going on with that share. And if not, or if a client wanted to just say, you know what, I just want to give it a go, then I'd say to them, fine, invest what you would be happy to lose. And if you make money, great. But if you lose it, don't be upset about it. And so lastly, I just wanted to touch on what are we likely to see with the development of artificial intelligence. We've spoken about returns, we've spoken about investments, liquid versus illiquid investments, passive versus active investments. We've talked about portfolios, different types, conservative, balanced, and growth, and what kind of aspects you should consider there. We've talked a little or touched a little bit on crypto, but there is also artificial intelligence. And I was at a really interesting investment seminar yesterday where we started to look at the role that AI would play and how it's going to potentially change the world and change the way we invest. and how the decisions we make will be based on what we can learn from AI. So I think what one needs to just remember with artificial intelligence is, what is it? Because it can seem a little bit scary, but it is actually a data chip that is processing a huge amount of data. It's not making emotional decisions on your behalf, which I think people tend to think. They're like, oh, robots are going to take over. It is processing a huge amount of data. And what was fascinating yesterday was aspects that they brought up about how we as humans interact with data at the moment. So firstly, in terms of stock picking, in terms of choosing the right portfolio, because we're wanting to make as much money out of our investments as we can, well, AI will just be able to process the data of quite a few thousand companies and choose the top 30 to 125 companies in terms of what they could potentially earn in that market condition. So if we think about it today, we've got 76 elections coming up in the world this year. There are some pretty horrific wars going on at the moment. We've just come out of an inflationary cycle. There's quite a lot going on. So AI is able to look at all of that data and quickly process it and say, given these conditions, these are the top companies that I think one might benefit from. This means that we can make investing much, much easier. We can really look at a large portion of criteria and a lot faster. But remember that AI is very much in its infancy. We're all learning about it. So it's very much dependent on what information and what criteria and what parameters we put into that question. It's just collecting lots of information and putting it in one spot and going, okay, great, here's a scenario based on what you asked me. There's many ways to question or create a question relating to anything. You can use a number of different words. So one has to be quite clever and careful in terms of what you're feeding into that data aspect. But I think what it speaks to is comparing what AI can assimilate versus a number of different analysts who are looking at the same companies. Because those analysts will have different experiences. You might have an economist, you might have an accountant, you might have a scientist, you might have a trader. They will all have different experiences, and so they will view those companies differently. And there's no better option here at this point. AI is going to assimilate it based on the criteria you've given it. Those analysts will view it very, very differently, and they'll probably bring some really important aspects to the fore in terms of making those decisions. The big thing here is how fast AI can assimilate that information versus the analysts, and that's really what one's weighing up. But what I found really interesting in terms of investments and how we're going to be using AI is that people, when they interact with information, they tend to look at quite negative information, and we select that information, and AI is looking at what people are selecting. This was the theory that was presented yesterday. So, and why do we do that? We do that because we want to be able to be prepared for the absolute worst, and we want to be able to plan for whatever the absolute worst is. And so as we start assimilating that information and clicking on the negative, so a more negative approach is going to be presented potentially. And what's important about that is to also consider the best possible outcome in an investment scenario, the best possible solution for a family, the best possible solution for your planning. And the reason I'm bringing that up is because I think when it comes down to choosing investments for yourself, looking at returns, looking at how best to go about things, there's quite a lot of information. One doesn't have to be overwhelmed. You just have to have some kind of idea of what's going on so you can ask these questions. But yes, you certainly want to speak to an advisor and get their view on it and engage with them on these discussions. I think that's really, really important. So that really brings me to the end of our podcast today, which is really just about investments and the new world that we're going into. It really is just a taster. I was quite nervous about doing this podcast because there's so many different ways to look at investments. So what I've tried to do and what I've tried to present, and if I have misrepresented something, understand where the premise was. The premise was to give you an idea of how certain things work. There's always various caveats and specifics to any investment. I've just tried to give an overview as much as possible. And again, I'm also aware that, as I said earlier, that there are very sophisticated investors out there, and there are new beginners who are really wanting to understand how things work. And that's okay, because it's a podcast and no one needs to know what it is you do know and what it is you don't know. We're all on very different journeys. Every day is very, very different. Some days are good days, some days are bad days. But I think at the end of the day, we're just trying to not stop learning, making those slight little adjustments, making those little tweaks and moving forward. Remember, you define you. So define the life you want and go out and get it. Thank you for joining me.